I'm sure we'll still have some people joining us throughout the next couple minutes, but we will get going. So good morning, and thank you everyone for being here for today's webinar. We're really excited to dive deep into California's commercial energy storage market. In this webinar, we're going to be exploring the many dynamics that are influencing California's fluid solar and energy storage market, a lot of headwinds and tailwinds that we're seeing. And the goal of this webinar is just to break down those trends and share our insights as we forecast where the market is headed this year and beyond. So a few housekeeping items to mention before I hand it off to our speakers. As always, our Q&A is at the very end of the webinar, but if you have questions, please chat them into the chat box throughout the webinar, as we're going to be covering a lot. So we will get to as many as we can at the end. And this webinar is being recorded, and that will also be going out after the webinar, along with this slide deck. So we have a great group of speakers from Energy Toolbase on with us today. My name's Tracy. I'm just going to be the moderator throughout the next hour. We are joined by Jordan Fenner. She's an enterprise account manager who is very heavily involved in our Acumen EMS storage projects. Brandon Mays, our supply chain manager. And you might have read his recent battery and energy storage supply chain and pricing report blog that he published, which Adam will touch on a bit later. And again, of course, we're also joined by Adam Gurza, who's our VP of Business Development, who has spent the last few months researching this data that he is going to share. So with that, I will pass it off to Adam.
Thank you, Tracy. I'm going to bring up the agenda slide. Yeah, really excited for today's webinar. We have a lot of valuable intel and insights to share. Been compiling a lot of this from different data sources, like Tracy mentioned, both internal and external. As you can see here, we have a pretty big agenda, as there are a lot of big forces out there influencing the market today. And the way we broke this up is kind of into this idea of like headwinds and tailwinds in the market, which we'll be unpacking. So cool, I built this little visual. Yeah, as Tracy mentioned, I've been working on this deck for a little while, and I've certainly just forced myself to only include things that we think are really, really important, because there are so many big forces out there, and we're going to unpack each of these individually. So without any further ado, let's start with SGIP. Okay, so of course the self-generation incentive program. Everybody on this webinar I know knows this program in depth. For context, this is far and away the largest behind-the-meter storage incentive program in the history of our country, or anywhere in the world for that matter. We did a fresh scrape on the SGIP data set. What we're looking at here, and really a lot of this webinar is focused around the commercial segment of the market. This is the large scale storage category. We have, these are not completed projects, these are reservations, right? And just as a data point, we filtered out both canceled and suspended reservations. So these should be all legit large scale storage category reservations. Of course, the big spike in 2020, that was driven by the relaunch of the program in early 2020, when we got more funds for the SGIP program as a result of that Senate Bill SB 700. We're not going to be going into that in depth, but that really explains, the big uptick 2020 versus 2019. One thing I wanted to point out, I kind of forgot this when I was digging through the data. In the large scale storage category, it does include a fair amount of residential projects that were over 10 kW in size. That was the new threshold, 10 kW. Anything greater than that drew from this category, and there were a fair amount of those when I was looking through the data recently. And then the data over on the right here is basically showing 2017 through to today. And this just gives good context to see how much capacity has been reserved in each respective IOU territory. Okay, excuse me. Okay, let's talk now about what's everyone's thinking about, which is how much is remaining. And this is very fresh data. This is as of 5/16, so as of last week. And certainly when you look at it visually here, the blue versus the orange, you can just see like we are kind of getting down to the end here. on a percentage basis. SCE, of course, is already out of money. We're going to unpack that a little bit more on the next slide. SDG&E and PG&E, the other two big territories, 13 to 23% remaining. So it is starting to, the end is in sight, as we say. Okay, so one thing I'll just mention, there was this pretty important decision in December of last year. The PUC basically reallocated $67 million of funds from basically money that still had not been reserved, and they assigned it into other categories that had wait lists. And this definitely drew down the large scale storage budget category. And as a result, we did a lot of reporting on this. I'm linking to a blog our head technical writer, Aaron Christensen, put out that was really thoughtful. And, I encourage you to check it out. That just kind of talks about all of this in more depth. One of the headlines in that was in March of this year, so just a couple months ago, SCE officially ran out of large scale storage funds. And as you can see here, PG&E and SDG&E, I did some forecasting in terms of like how much time is left in my, I guess I'll call it like my base case in PG&E territory, has it at about 9 months remaining. So I think that puts it into like Q1 of next year. And then SDG&E, I see that very likely by end of year, based on the remaining funds. And based on the rate of reservations we've seen just over the last, let's call it year to date. One other thing to mention that we saw in the SCE territory was when it gets down to the end, right, and there's just a few $1 million of available funds left, you usually get this kind of acceleration effect where, all the developers in the market are going back to customers and saying, this is the last chance. If you want to get a reservation, let's do it now. And then you saw kind of an acceleration of reservations, and I would very much expect that in the PG&E and SDG&E territory as well. So maybe these estimates are even a bit conservative, and developers should now is the time to be going back to projects that are on the fence or open opportunities, I think. One other thing to mention that comes up a lot in questions is like, okay, well, what's the possibility of SGIP budgets getting replenished? And I think the answer there is we have to assume in the short and maybe even midterm, I don't see a path for that. When the 2020 budgets got replenished as a result of that SB 700 bill, which we were actively involved in, as were a lot of other folks in the industry. That was a 2-year legislative process. That literally there was a bill that got passed out of the legislature, got signed by the governor. It was a pretty lengthy process, and that's what would likely be required again. So we should not be counting on a replenishment anytime in the near term is my opinion on that. Okay, let's move into the next category. Another really big one, and that's the ITC. And we also have a bit of a step down and a cliff on the horizon there as well. Everyone is very, very familiar with this, visual or just kind of the step down schedule. This is from SIA. This is obviously for the solar tax credit, but it very much applies to storage as well. When you're pairing storage with solar. And this is after, Congress passed a 2-year delay of the phase down in 2020. So today, everybody knows we're at 26%. That goes down to 22% next year, and 2024 and beyond for the commercial and utility scale segment, it goes all the way down to 10%. So let's see, everybody, I don't have to summarize the ITC. It's been like maybe the single biggest incentive in the history of solar for sure. SIA has all these statistics on their website on how it's just driven. I think there's some crazy stat like 10,000% growth in our industry for solar since 2006. So it's obviously a really, really big, important, piece of the puzzle and making projects pencil. I've got a couple quick slides here. This question comes up a lot. I know this is a little bit wordy of a slide. I'll just summarize this. You know, when it comes to ITC qualification language, and you know, when you would qualify for those different you know, thresholds, you know, especially the commence construction language guidance that's out there, I think a lot of folks look at, and this basically just says, if you can satisfy either one of these two tests, you know, having started physical work of a significant nature at the site, or incurring at least 5% of the total project costs. And in addition to that, you make continuous progress towards the completion of the project once construction has begun, you would then qualify for that level, right? So if, you know, let's say in December 2022, you pass one of those tests and you are making progress towards that on that project, you would qualify for that 26% level. And I actually had a note here. I want to definitely have the disclaimer: Energy Toolbase is not a tax advisor. We source this language exactly from, you know, SIA and other reputable sources. K&L Gates is a law firm that's put out a lot of really good information on this over the years. And this will very much come into play. So I wanted to have a slide including this. Let's talk next on the possibility of standalone ITC legislation or a extension of the solar tax credit as we know it today. You know, the really quick history on this is the big Build Back Better bill died last December, which included in there, and that bill originally did pass the House, which was a pretty big, you know, hurdle to climb. It very much included tax credits, $320 billion worth of tax credits, including, you know, a 30% solar ITC extension, and also what, you know, the storage industry has been lobbying for many years, which is a standalone energy storage tax credit that also happened to include direct pay language, which would be, you know, really exciting and lucrative for us. So again, that bill died. Now the best and kind of most realistic chance we have of an ITC extension and a standalone tax credit is through a narrower and smaller bill. And there's a lot of reporting out there on this topic. There's a lot of that reporting says that that portion of the bill has support and might even have the votes on both sides potentially to get that done. But it's, you know, it very much remains uncertain. I think a lot of the reporting that I've read has certainly said that the chance of this happening, it would really need to happen before the midterms, which are what, 5 or 6 months away in November, because afterwards it becomes a lot less likely. So that's the summary here. We don't really have much more to share. We're obviously continuing to be in wait and see and hope mode. And then in terms of, like, you know, what would this mean? It would be massive. You know, the passage of a standalone storage tax credit would potentially be, you know, one of the biggest tailwinds of the decade for the industry. There's lots of data out there. I'm not going to go too in depth. I think Wood Mackenzie had some projections around, you know, at least like a 25% increase in storage deployments over the next 5 years. And obviously it would be really important because it would be, you know, it would be eligible in all 50 states, and you know, the direct pay component as well would be really lucrative for different projects. So that's a summary of the potential of an extension and standalone legislation. And again, at this point, we're just in wait and hope mode, and certainly folks like SIA, if they make another push on this in the next couple of months, will be very supportive, and I'm sure the whole storage industry will be. Okay, so now I built a couple charts as we start to like visually think about this, just overlaying both the SGIP and the ITC on top of each other. The top, I guess, part of this Gantt chart here is just, let's just assume maybe for a commercial storage project or a commercial solar and storage project that's getting sold today, roughly maybe a 12-month timeline or cycle from sale to PTO. And of course, that's going to fluctuate a lot, maybe 3 months quicker or later at least. But just where does that land us in terms of, SGIP fund availability, also that ITC level. And then I have some slides coming up on the NEM2, NEM3 transition. But, let's just assume a project gets sold today. That likely would still mean a potentially a 22% ITC, because that project would very likely commence construction in 2023. There would likely be a NEM2 project, which again, I'm going to unpack a little bit more in a minute. And then if you're in the PG&E or SDG&E territory, you would be able, there are some SGIP funds for that project. And then just going ahead to the next slide, okay, let's now just move this forward and assume for a project closing end of this year in 2022, 12-month cycle really puts that PTO towards end of 2023. You would likely get a 22% ITC. Again, if you're starting construction in 23, it could very well slip into a 10% if that doesn't commence construction until 24. That almost very likely would be a NEM3 project, and you can assume with certainty there. Well, I shouldn't say with certainty, but there's a decent chance there will not be SGIP funds for that project that's closing end of this year. Okay, we're going to come back to that in a little, and this is going to be a segue where I'm going to pass it over to our supply chain manager, Brandon Mays, who put out an awesome report recently. I hope you've seen it. That's just going to give a bit of an update on energy storage supply chain and pricing that we're seeing out there. Mr. Brandon.
Thank you, Adam. Yeah, so I've got this slide here. I'm really just going to kind of stick to this. There's just a ton of information in the report, and if you've had a chance to look over that, some of the high points that I'm going to touch on here might sound familiar, and if not, check the report out. I'd love to have a webinar like this to deep dive on it, but just in the interest of time, we'll keep it kind of brief. Now, the report that you would see was published last month. So rather than kind of go over what was there, I'll talk about a little bit of what's happened since the report was published. And then, we're talking about headwinds here, but I also want to touch a little bit on how ETB is responding and, maybe give a little guidance to developers out there as far as what to expect, setting expectations with the end users. So, at the top of everyone's mind, certainly mine in the last 2 years, has been disruptions related to COVID. And certainly the first quarter of this year, there's still a lot of remaining challenges and lingering backlogs and just congestion in general in the supply chain around COVID. Certainly, China's decision to lock down major cities like Shenzhen, Shanghai, and others, just further compounded the existing issues there. So we saw reduced production output, lower inventory levels, and just a lot of the ripple effects, extended lead times, higher prices. Now, some good news here. Since the report was issued, Vice Mayor of Shanghai announced just last week that at least in Shanghai, they're going to be lifting the COVID restrictions starting June 1st. So, with the expectation it might take a week or two to get back up to speed, I see this as a good sign for any kind of procurement, any materials moving out of China especially, should start to see a little bit of relief, at least relative to what we've seen in the last quarter. Now, raw materials, I'll touch on that briefly. Raw material prices have just skyrocketed in the last year. I mean, we've seen 180% price increase on average for lithium, nickel, and cobalt, and other key materials, manganese, iron, steel, aluminum, all have seen really record price increases. Now, it looks like that increase is starting to soften. The increase is not as fast. Now, this could indicate a plateau. I sure hope it does. Could prices still go higher? Sure, but I don't think we'll see any major lifts in price, at least on the raw material side from what we're seeing now. So we're talking single point percentage increases, not more double digits. So looks like we could be seeing a plateau in pricing there for raw materials, which, as those prices, as we find a new normal on the plateau, or if they even start to come down, we could see some relief. But I suspect we're still 12 to 18 months away from seeing those kind of knock-on effects. I'll move to electric vehicles now. Certainly, storage is in close competition always with electric vehicles for raw material inputs for batteries, and even more so now as we're starting to see Tesla, Volvo, and other large EV OEMs shifting the kind of chemistries that they're looking at, and looking at like lithium iron phosphate, which typically was common in China, and typical in storage, not so much EV, but now as all companies, EV, storage, and everyone in the market is looking for, that next, cutting edge technology that they can also work through the supply chain. LFP and others are starting to come to prominence. So I see, continued competition with the EV industry as the EV industry grows, as well as storage grows. Now, I do want to touch briefly on inflation. I mean, it touches all of us in our professional and personal lives. We're certainly in a historic moment right now with inflation. We've seen over the last 2 years, um, you know, contraction in economic activity, but still high demand from consumers. And so, in addition to a large amount of money being injected into the U.S. economy by the Federal Reserve, it just kind of created this perfect scenario for what looks like stagflation. And it looks like it's kind of here to stay. It's probably the new normal for at least another 12 to 18 months. Looks like we'll be feeling the effects of this inflationary period. I do suspect that by late 2023, we'll start to see some of the inflation unwind. But the guidance that we're giving, and how ETB is responding is, we we expect inflation to subside in throughout late 2023, but it's unlikely that we'll get back to, say, levels below 2019. So we will see some relief, but probably not back to levels that we saw pre-pandemic. And finally, I'll touch a little bit on shipping and transportation. It's kind of a similar message here with inflation. We've seen a little bit of relief in rates, and that's ocean freight rates. We've seen container rates come down. They're still historically elevated, still well above 2020 levels, but coming down and seeming to hit a plateau. And similarly for U.S. trucking rates, we've seen a bit of a drawback there as shippers are looking to move away from spot rates and move more toward contract rates, locking in that contract pricing that can be more stable and predictable for the business. So with all of that said, it's a lot to take in terms of the headwinds. We're certainly in a difficult supply-demand environment right now. So some of the things to keep in mind is looking at where you can, securing contract pricing longer term, building inventory levels at today's pricing in anticipation of a future increase in pricing. It's another method that we can use to hedge against higher prices in the future, and just keeping a close eye on the market. It's very volatile, very frothy right now, and things could change dramatically, like we saw Russia's invasion of Ukraine. Boom, black swan event, and just more fuel on the fire for things. So, we exercise caution, but we're still seeing strong demand out there in the storage business, and a lot of good people dedicated to working through these supply chain issues. So I'll leave it on a positive note there, and happy to field any questions you might have as we get closer to the end of the webinar. Thank you.
Awesome. Thanks, Brandon. Man, yes, an awful lot to take in. Really encourage you to check out that report if you haven't already. We're intending to make that a quarterly report authored by Brandon as, you know, all these items change in the market because we really want to be able to answer, well, why are lead times long and prices in some cases going up. So thank you for all of that. And with that, let's move into another big meaty one. We're just going back to back here. This is as big as they get. NEM 3, everybody's following this in California. I'm going to talk mostly about, you know, like our thinking around how this affects storage. You know, obviously for solar, why don't I start there? It's without question, it is an existential threat to our industry. We are fighting back very hard against this. I have a slide talking about that. It's, I guess, interesting and both ironic in some ways that for storage, NEM 3, we have in the tailwind category, which I'll be explaining a bit more as well. So let me keep this piece really short and sweet, you know, just summarizing the December 2021 proposed decision. It's been a full 5 months now since that dropped. Everybody knows there was just massive backlash against that PD. And effectively, it's been rejected. You know, usually when they put these PDs out, they intend to vote them out and finalize them in the next 30 to 45 days. And the PUC, in a lot of ways, has gone back to the drawing board. The 2021 proposed decision, and you can see the summary on the screen, what that meant for the commercial market. Just huge disclaimer to say that you know, this is not necessarily at all what we expect to get, and there are changes that are getting made. We don't know what those will be yet, but let me just do a super quick rundown. Obviously, the avoided cost calculator being used to determine the export rate was a really big piece of that decision. It's also interesting that they went with these hourly time of export periods. I'll talk about exactly what that means in a minute. The ACC calculator will get updated every year. For the initial December decision, there was no fixed charge, grid benefits charge for commercial customers that only apply to residential. The PUC proposed to use this market transition credit as the glide path mechanism, which was basically going to give you, you know, based on the solar capacity that you were looking to install, that's how they would kind of phase back and, you know, attempt to ease the move to NEM 3. And then again, folks are also aware of some of the other things that were really rejected in the original PD, the 15-year term getting shortened on NEM 2 grandfathering, this concept of instantaneous netting of exports, and then also monthly true-ups. And really encourage you, once again, Aaron Christensen wrote a really extensive blog on this. If you want to deep dive on this, I'm sure everybody already knows this, but we do have that. I will say the December PD is really, frankly, out of date and not what we're looking towards. The most recent update we got just broke a couple weeks ago. I'm sure everybody who I hope is a member of CALSA is very aware of what just came out, and it was very unexpected when the PUC effectively reopened the record by requesting feedback from parties on a few specific issues. The solar tax, the glide path, and then low-income community solar. It does show the hand a little bit in terms of what the PUC is thinking, and I'm assuming these are now open topics that they're looking to change. It doesn't really tell us what they landed on for the other items in the December PD. There's been lots of speculation, but in my mind, it's speculation because we don't necessarily know where that is. I'm not going to go too in depth on the May issues. You know, the glide path is certainly interesting. What was in the this May update they circulated, you know, there is this new concept that they're floating of like ACC plus, which would effectively be like an adder to the export rate that gets phased down over time. So that would, you know, basically be a rework to the glide path mechanism. That is very much in line with what CALSA and other solar parties originally proposed, which was to, you know, phase that down instead of this market transition credit that based it on, you know, the PV KW solar capacity. So that'll be interesting to see how that plays out. I think the last thing to mention here is on the bottom, just what does this mean for the timeline? So the comments are due initially on June 10th, reply comments 2 weeks later. This pushes the final decision to the absolute earliest of end of August. And this assumes that, which is probably a big if, that they put out a revised PD and it gets voted out. That would be at soonest end of August. And then in terms of implementation, which comes 120 days later, that would land us towards right around the end of the year. Right end of December, maybe beginning of January. So that certainly does push the timeline out a bit. I do want to unpack a little bit more because this is what really relates to the energy storage piece, and that's how exports get valued. At the end of the day, the big takeaway is, well, what will solar exports be worth on average? And the answer is, and this is data that we ran right after that December PD came out. We had it depending on the system and some specifics, but in the neighborhood of about 5 to 6 cents per kilowatt hour on average. And it turns out this lines up very closely with what CALSA calculated when they ran these independently. So this is the part that really affects storage. Obviously with a reduced export rate, which is greatly reduced from where we're currently at in the market, which is retail less non-bypassable charges, which are just a couple of cents. This would obviously create a big and strong price signal for storage to prevent solar exports to grid. And in that sense, that's why we've kind of listed it as a tailwind for storage. It frankly would just create a strong price signal and opportunity. We had this slide from a webinar that we held earlier this year when we were summarizing our thinking on this NEM 2 to NEM 3 transition, what that will look like. Again, disclaimer, this is based on the December decision, which we know will not get adopted. But for this particular run, I think it's just good for context. For 100% offset solar system, this was for a church in the SDG&E territory. For this particular project, almost 60% of PV would get exported to grid. On average, for this run, it came in at about 6 cents. So that's really taking a huge haircut. And that would take the average blended value of solar down quite significantly. In this run, it took it down 33% from 26 cents to 17 cents. So that obviously erodes solar's value a lot. Storage savings conversely go the other direction. For this particular run, it was a whopping kind of 62% increase, going from $85 a kilowatt hour of storage capacity to 137. So this was, I would say, a bit of an extreme run because there was just a lot of exports here. That's not necessarily always going to be the case for commercial NEM 3 projects. But the point here is it just shows it really truly can dramatically increase the value of storage in a NEM 3 world. So again, the bottom line is, solar gets eroded. The value of solar on average goes down. The value of storage goes up as a result of the strong price, the strong self-consumption price signal, and therefore the ratio of solar to storage savings goes up. And the expectation is pretty broadly, this is not, everybody feels this way, that in a NEM 3 world, the attachment rate, the amount of storage projects that are getting paired with solar will likely go way up. And this will be true for residential in addition to commercial. And again, big asterisk on this slide. This is based on the 2021 December proposed decision, which will not get adopted, and there will be changes. But to this point, this is the most we know. So I wanted to just give this for context. Last slide in this section, huge shout out to CALSA. They have just done incredible work, tireless work, fighting and working on this proceeding. Kind of fighting for our collective interests. We've all got to continue supporting them and just keep the pressure up. The big call to action now, they got a couple rallies coming up in a week. June 2nd, there's going to be one in San Francisco, another one in LA. I know this is the second time they're doing it, but we just got to turn out for these and just show support and force. I'm actually going to be at the Los Angeles one next week, which I'm excited for. And then join CALS if you're not already, and donate to the fund. So I just wanted to make sure I got that in. Okay, I got a couple more slides, and I'm going to bring in Jordan. And there's some really interesting data now that we've sourced internally that we're going to be sharing. We did our first ever kind of developer survey. We got a pretty good response. We actually still have some responses trickling in, about 60 to 70 responses. I've actually hyperlinked the survey here. So if you haven't taken it already, please do. It's not too late. I'll just run through a couple of the answers we got. The question here is, what are the biggest hurdles preventing you from deploying more storage projects today? Check all that apply. No surprise at all. Economics ROI was number one. Also not a surprise to me, kind of following up on Brandon's segment, procurement and kind of long lead times was listed as the number two. Let me keep moving quickly. I'm kind of looking at the clock here. This was an interesting one. What do you think are the primary motivators for your host customers adding storage? I filtered out, and we're only looking at the commercial responses here. Again, not surprising at all to see strong economics, number one. It was interesting to see how close of a second place backup power resiliency came. It's like literally neck and neck there. So, I certainly expected to see, a lot of that being a motivator for customers, but I know for the residential market, it's widely believed that that's oftentimes the number one driver. Our early data is showing that it's a very, very close second in the C&I market as well. This was a really interesting one. This one actually, I got to tell you, caught me by surprise a little bit. It's better than I would have expected. We just ran through some of the headwinds that are out there in the market. These are real. Developers are very, very optimistic in terms of how much storage they expect to sell and deploy this year versus last year. That's great to see. We're, our business, our energy tool-based storage business, we are as optimistic and bullish as ever as well, which I'm going to talk about on my last slide. But this is a really good sign, and this is certainly sentiment. I suppose it's a tailwind and it's positive. Okay, my last section before turning it over to Jordan, some really interesting data here. We've done some anonymized digging into proposal generation activity on the ETB Developer platform, and specifically looking at California data. And I've got a few data points to show that I think are really interesting. This one dates back actually to the very beginning when we launched back in 2014. Showing not only total proposals, total California proposals generated. So you can see that line is obviously up and to the right. It also shows the attachment rate, which is certainly growing pretty consistently there. 2019 to 2020, we saw a dip. We think there's definitely some correlation with COVID, and there was pretty crazy just 2 years ago, what the world was going to look like. And there was certainly a little bit of pullback in proposal activity in 2021, and we're already tracking. I don't have 22 on the slide here, but that is already tracking quite a bit higher versus 21. And again, attachment rates are on the rise, and certainly in an M3 world, I think 2023 data, I'm expecting to see a really large step change jump in attachment rates for California proposals that are getting modeled on the platform. This is an interesting one as well, showing the number of accounts. Okay, these are individual accounts in Energy Toolbase that have modeled a storage project in California. This is actually residential and commercial data. I didn't filter it out, but yeah, I mean, just a huge ramp here. 70% compound annual growth rate on this from 2014 to 2021, which I think is a very bullish sign. This is kind of like a leading indicator. It's just breadth of like the number of companies that are modeling storage, and it's encouraging to see this, and we expect this to continue growing as well. This is another pretty meaty slide. This is actually an incredibly valuable slide. I'm just going to talk on this briefly. What this shows is for all of the California commercial energy storage runs on the ETB Developer platform, we kind of teased out a distribution of what the typical energy storage savings look like, and we're showing this in terms of dollars per kilowatt hour of storage savings, which I think everybody knows, total bill savings from storage divided by total bill capacity. So really interesting here, you know, the median, okay, for all commercial storage runs in California on the platform, about $47 per kilowatt hour. So if you're above that, you are, you know, greater than average. If you are greater than $66 per kilowatt hour, you are a top quartile project. So just an interesting data point, and we're starting to, you know, think more deeply about this. I had one more slide. It was really interesting. The SDG&E breakout, it turns out of the 3 IOUs was certainly the best of the 3 utilities in terms of like the distribution and where that median landed. It was actually a bit surprising to me to see. I didn't realize it was that high, but a median storage savings commercial project on the, you know, modeled on our platform in SDG&E was actually $70. You need to be north of $99 to be a top quartile. So really interesting data. We expect to share more breakouts like this into the future. And with that, I am going to pass it over to our enterprise account manager, Jordan Fenner. She's based down in San Diego, and she's got some really important other tailwinds to hit on as well. Jordan.
Awesome. Thanks, Adam. So continuing on with the theme of tailwinds and opportunities in the market, can you go ahead and go to the next slide? So demand response programs, they are a perfect example of ways to extract more value out of your energy storage projects. So grid services like resource adequacy and demand response, or commonly known as DR, they're more common in grid-constrained markets like in the Northeast, but California's ISO has a demand response program called DRAM as well, amongst a few others. So DRAM was created in 2014, and it allows aggregators of DERs to participate and to contribute essentially to grid stability. So sellers basically bid aggregated sites into the CAISO day-ahead energy market, and then in turn they're compensated for curtailing. So ETB is actually deploying its first projects now with Leap Energy, and Leap has been a great partner with multiple options for resource adequacy participation in California. And we will be making more announcements on how you can participate in the DRAM and RA programs later this year. So if you have projects that you want to discuss now, feel free to contact your account manager, and they will tag in someone from our enterprise team, such as myself. But what I'd like to do is direct your attention to the slide here and the scheduler. So one other item to note is that our special programs release just went live in ETB Monitor. So you can see a snapshot of the interface here. And what it does is it allows customers who use our battery controls to view and manage participation in DR programs, not just in California, but across the US as well. So with the click of a button, you can essentially control your entire fleet or portfolio. And this is a really powerful tool that we're super excited about. So feel free to reach out if you're interested in getting more information, or if you would like a demo of our ETB Monitor platform. Let's go to the next slide. On another positive note, but positive depending on your perspective, is the cost of electricity in California. It continues to rise. There's no doubt about that. We're seeing some of the highest retail electricity rates in the country. And we found a great resource from Revel Energy. They are a C&I developer based in California. And so in these tables, you can see the historical retail rate inflation over the past 30 years on the left-hand side. and then the projected increase in costs up to 2040. And a lot of recent rate increases are being driven by grid hardening and modernization efforts due to worsening wildfires. There's also a lot of distribution and transmission upgrades that are a consistent concern. All the while, natural gas costs continue to rise. So while this may not be great for end users, there really is an opportunity for our solar and storage industry to help transition us to renewables, and at the end of the day, to save people money. So depending on how you look at it, there's definitely an opportunity here. So let's go to the next slide now. Financing integrations, most definitely another positive here. So financing for solar and storage, it's seen a lot of growth in the past 5 years. It's becoming a more mature market, and it's becoming more cost competitive with more options for credible providers. So the approaches are really being standardized. How you create an equitable rate that includes storage is no longer some crazy complex calculation. A lot of this is streamlined. And in line with the market, we have recently announced the launch of our financial integrations feature. And this is in our ETB Developer platform. So once you create your model, your solar and or storage project, you can now get instantaneous financing quotes. And you don't have to go in, extract the data, manually request a quote from the financing entity, and then wait for a response. We just hosted a webinar with Greenbridge to give you some more details on this. They're our first financing partner that we've launched onto the platform. But once again, if you're interested, reach out to your account manager. We can give you a recording of that webinar. We can give you some more details. We're already seeing a pretty big volume of quotes being generated, and our analytics are showing that a high percentage of the economics for these projects are looking great. So that goes just in line with what Adam was talking about earlier, and the average unit savings that we're seeing for these projects, especially in SDG&E territory. It's looking great, and you're now seeing financing that reflects that. So we will be announcing many more financing partners and options in the very near future. So stay tuned, stay posted, and make sure that you're testing that out if you're a user of our platform, and get some quotes, get them quick and easy, and then move through your pipeline a lot faster. Next slide, please. Okay, so our services. I'm just going to do a little recap here. So with over 1,400 active users, most everyone on this webinar is probably familiar with Energy Toolbase for our ETB Developer platform, the first box on your left there. It allows developers to transparently and accurately model solar and storage performance, its savings, and then present those project economics to end users. And we've been in the market with this product for about 8 years now. But some of you may be less familiar with our Acumen EMS product, the center box here, which is advanced control software for battery systems. And it's been in development for over 6 years. So our controls use machine learning to forecast and then optimally discharge the battery systems under a variety of different control strategies and programs, depending on the region and the site-specific needs. And we have fully integrated with a number of leading energy storage vendors. So companies like BYD, Stoka, Tesla, already integrated with them. So focusing on here is our ETB monitor. When you purchase controls, it comes with ETB monitor. And as you may have noticed now, value transparency here at ETB. Monitoring system comes with our Acumen, no additional cost, because we see the value. We want our stakeholders to be able to manage system performance in real time and make sure the system is functioning properly. So today you can see that we cover the intelligence layer end to end for distributed energy systems. We are actively deploying Acumen onto battery projects in California, and in the NEM 3.0 world that Adam was talking about, we expect to be doing a lot more. So if we're not already talking to you about Acumen and ETB Monitor, we would love the opportunity to. We have options for easing the procurement process and reducing lead times. So please reach out if you would like to learn more. So thank you everyone for tuning in today. I am going to pass the ball back to Adam.
Awesome. Thank you, Jordan. Great job. I mean, just those 3 topics alone, we could have done our own webinar on, just because they're meaty and they're important. I'm going to do a really quick wrap up, then we'll go to Q&A. I know we're running long already. Tracy's nudging me. Maybe we can run a couple minutes over on Q&A, Tracy, because I know there's a lot of questions trickling in. You know, my last slide, it's tricky to summarize and conclude this presentation. We, you know, just covered a bunch of major forces in the market at play, headwinds, tailwinds. You know, if you really want to think about it on the next level, you could even argue that, you know, both SGIP and the ITC step down are in some ways they're tailwinds now, right? Because developers and host customers are, you know, they have urgency to move quick and get projects in. But these can become headwinds if and when they step down. All I can say is we will continue reporting on all these items. It was actually a lot of fun preparing this deck and thinking at a 10,000 foot view. And then the final thought before Q&A, I'll leave you with, you know, just speaking on behalf of Energy Toolbase, we are certainly very bullish still and optimistic for the continued growth of the California market. We didn't share a lot of other internal indicators, but we are just growing on all fronts and deployments for storage projects in California. And with that, Tracy, looks like I will let you manage Q&A and start firing away questions.
Sure. Yeah, and Jordan, Brandon, Adam, if you see any questions you want to address, please do so. And yeah, so a couple questions. This is being recorded. We'll send out the recording and the webinar slides after, so be on the lookout for that email. Brandon, this is a good one for you. With all these supply issues for energy storage projects, what is ETB doing, and what should I, as a developer, be telling my customers to manage their expectations?
Oh, that you know, that's a fantastic question. It really is. So at ETB, I mean, we're in this market along with you guys and everyone else, and you know, as we saw and continue to see lead times, you know, extending and prices rising, you know, one of the first steps that we took was moving our fulfillment to fulfill from inventory rather than just buying on the spot market each time a deal was closed. And in doing so, you know, it took us a little while to catch up on the cadence, but now, you know, since we're able to fulfill from inventory, we're reducing our lead times, and our pricing, our avoided cost in the market has become very competitive versus buying just from the spot market. So, you know, we've kind of been able to pull our own pricing and lead time back in time. And you know, so that's one thing that we've done that we've also you know, we would recommend as well. And you know, just in general, I mean, we're always talking with our hardware integration partners to get a feel for what's impacting their business and what they're seeing. You know, right now it does look like there's a little bit of a calm, but I kind of warn it might be the calm before the storm, because we're going into what is typically a very busy season, going into summer and then certainly fall and Q4. So, you know, I just caution in terms of managing expectations. You know, expect lead times to stay roughly where they are, anywhere from 8 to 12 months for larger battery systems, and expect prices to stay, you know, roughly in the same zone. You know, at this point, even if we saw a 20 to 30% pullback, we'd still only be at 2019, 2020 pricing. So I think higher for longer is probably kind of the expectation to set. But certainly, you know, ETB and you know, we're working very diligently to find mitigations, find strategies that we can offer our developers and the end users in terms of you know, more competitive lead times and pricing as well. Good question. Thank you.
Thanks, Brandon. We got a couple about this one. Governor Newsom recently announced a carve out for new storage incentives in the California state budget. Adam, maybe you would be best to talk about that one.
I'll hit that one quickly. You know, that kind of caught us by surprise a little bit. I think that was last week or maybe 2 weeks ago. I think it was a big number. I think it was like $970 million that was floated as additional storage incentives in the budget. All of this, my understanding, is for residential. I think a big carve out, I think it might have been 670 was the number that was earmarked for low income. And then 300 million was earmarked for retrofitting storage to existing residential folks that have solar. So my understanding on that money is it's pretty much exclusively residential.
Gotcha. Thank you. Jordan, this one would be best for you. You touched a little bit on the financial integrations, but can you go a little further into the process if somebody wants to get a PPA quote through the ETB Developer platform?
Yes, absolutely. It's pretty simple. So when you log into the platform, you would go into one of your proposals, and under your transactions, you'll click on Greenbridge as an example for the first one and apply for the integration. Once you're approved, you can go ahead and run through your normal modeling process, and you would put in your meters and then model your solar and your storage if applicable. And then you would go in and you would add that Greenbridge transaction in, and it would automatically run the PPA numbers for you, and it would push it into your cash flow. So that would give you a budgetary quote to present to the end user. And then if they decide that they are interested in moving forward, we would need to dive into the details a little bit more, get some mutual NDAs in place, get copies of the audited financials for the past 3 years, and then review the project with them in more detail to make sure that we can move forward. But it shouldn't really disrupt your normal process flow. It's just adding in a transaction like you would, but instead of putting in the boilerplate template or a PPA or a lease or a loan, it'll automatically pull in that rate for you.
Awesome. Thank you, Jordan. I know we're getting towards the top of the hour. We got like a minute left. So maybe if there's any other Adam, Brandon, Jordan you want to touch on quickly, we definitely want to be conscious of everyone's time here.
I will speed round a couple. There's some really good ones coming in. I hate when we always get cut short on these. You know, what determines the NEM2 eligibility for C&I customers? This one I was actually going to have a slide or a bullet point for, but I think we can say with very high confidence that the submittal of the interconnection application will lock your NEM2 eligibility. So whenever that cutoff date gets set, let's just say it's December 31. My understanding is, assuming it's pretty well finalized and there's not material changes, the submittal of the interconnection application would get you that NEM2 status. Chris Shirley is asking a ton of good questions. I will probably just move really quick through some of these. Let's see, boy. Yeah, those charts that we again sourced from Revel. Thank you, Revel. We linked back to your blog there. It's so difficult finding good, solid. I've been struggling with this for years. Historical right increase data out there, especially if you're trying to get it specific to a certain market like C&I. I've just never found you know, good data set. So Revel is a very credible company, longtime user. But we're just strictly sourcing from there. Yeah, I did also catch in the recent May PUC decision, there was it sounded like a walkback potentially of them looking to impose these, you know, non-bypassable or solar fees on commercial customers as well. And again, with the May ruling, it's just so new. It'll be interesting to read like parties' comments, so it's hard for us to comment much. But that certainly did catch our eye as well. I didn't have it on that one slide. And then just maybe really quickly, lastly, I know we're already late on time. Chris was asking about, you know, we had a slide showing the number of companies that have modeled a storage project in California. Those were companies, not seats. The reason that number doesn't necessarily line up with the number we use a lot on our website, you know, I think it's like 1,400 organizations that are current active users of our service is because we certainly have free trial start and customers come and go, but that number was an account number, not a seat number. I will leave it there. There's so many other really good ones that are coming in, Tracy, and I didn't even get to all of Chris's, but I just don't want to go too far over time.
Yeah, if you have any questions that we didn't get to, or just think of one after the webinar, please reach out to your account manager. They're there to help you. You can set up a one-on-one meeting with them. And if you're not a user yet and don't have an account manager, you can set up, we'll be sending out a link to set up a one-on-one with our team to get any questions you have answered. We're definitely here to help. We put on these webinars to help you get more projects deployed. And yeah, we want to thank everybody for joining and thank our speakers. Jordan had to run, so Brandon and Adam are still on. But yeah, thank you all for joining, and have a great rest of your day.